This week on Q&A, the former chairman of the Federal Deposit Insurance Corporation, Sheila Bair, discusses her book titled Bull by the Horns, Fighting to Save Main Street from Wall Street and Wall Street from Itself.
Sheila Bair, former Federal Deposit Insurance Corporation chairman. Why did you write a book about your experience?
Well, it was an important period of history. I felt that the FDIC's perspective should be brought to bear. There had been some other accounts of the crisis that I thought were not completely accurate, especially in terms of what we did and what I did. So I thought it was important for the historical record to present our perspective. And also, I think currently, for people to understand that there were different policy choices, different policy options, disagreements, and that if we want to prevent this crisis, another crisis from happening again, I really felt that the public itself needed to engage more on financial reform, take a bigger interest in it, educate themselves better, make it an issue with their elected officials. So I tried very hard to make the book accessible, and I have some policy recommendations at the end of it that I hope people will look at and take seriously.
Where did it all start for you? Where was your birth town?
Oh, Independence, Kansas, which some people think there's certain symmetry between my personality, which I've been known to be a bit independent, and my hometown of Independence.
When did you first know that you were going to be an independent type of person?
I think I've always been, had that streak. You know, I think I grew up in southeast Kansas. Independence is a small town. It's an economically depressed town. People there have always had to be a bit scrappy. It's isolated. There's not the bad roads going into and out of the area. That's improved a little bit since I've moved away, but it somewhat is reflective of where I grew up. My parents were Depression-era kids. They were both very poor when they grew up, and so they had a lot of strength. You know, they were self-made people, and I think imparted that to me as well. So it's probably a personality trait I've had pretty much throughout my life.
Where did you go to college?
Kansas University, a college and law school. I'm a product of public schools all the way through, and I think my public school education served me well. It saddens me that we've had a deterioration in public schools in various parts of the country, because I really think that is so basic to what America's about, giving everybody an equal shot at opportunity, and really that has to start with public education.
How many years total have you worked in government?
Oh golly, a lot. Most of my career. I would say since 1981, really. Let's see, with the exception of probably about 25 years in public service.
First job in government?
First job in government was the old Department of Health, Education, and Welfare. I was in the General Counsel's office. Actually, I was a civil rights attorney. I did civil rights work, Title IX, dealing with gender discrimination, Title VI, race discrimination, and Section 504, which was a disability rights law that had just come into law not long before I joined. So that was a very good experience, and actually led to my next government job with Bob Dole, who at the time, that was 1981, the Senate had just turned Republican. He was the chairman of the Court Subcommittee of the Senate Judiciary Committee, and there were a lot of big civil rights issues coming up. At the top of the list was the Voting Rights Act extension, and he wanted he's always been very interested in civil rights issues, and wanted to make sure he was a player, and was looking for someone with civil rights experience, and I had that, so it was a good fit.
Did you agree with him in most things?
I did. You know, I did. I think people, I think, tend to identify me with the progressive camp. Or I hate labels, don't you? I mean, it's just, you know, as because I've taken strong stances on Main Street issues, loan modifications, things like that. But I'm a conservative in the traditional sense. Maybe people don't view folks like me as conservative anymore. But a markets orientation, a belief in capitalism, but believe that system has to be policed and regulated. And also the government should be for the little guy. The government shouldn't be an insider's game designed to help people who already have privilege. It should be to make sure that there's an even chance for everybody to participate. So it's a kind of a populist brand, maybe, you know, William Allen White type of republicanism, but I think one that was reflected in Dole's politics. And yes, I had tremendous respect for him in the 1980s, what he did on tax reform. You know, the 86 Tax Reform Act really cleaned out a lot of these special interest exemptions and enabled marginal rates to be lowered for everybody. By doing that, the 83 Social Security Compromise that fixed Social Security for 30 years, again through a combination of benefit cuts and tax increases. So that was the kind of bipartisan leadership we needed, that we had. And I think he, in addition to his good old Kansas common sense roots, his service to our country and the terrible wounds he suffered, I think, gave him a tremendous strength, and he understood what it meant to put country first. And I think that World War II generation understood that. You put the country before your own personal interest, your re-election process, or whatever. We had that back then, and we don't have it so much now.
So how did you become head of the Federal Deposit Insurance Corporation?
Well, I was teaching at the University of Massachusetts in Amherst. I had served in the Bush administration earlier as the Assistant Secretary for Financial Institutions. And for personal family reasons, I had a son, and we just adopted a daughter from China, and I wanted more time with my family, and academia was a good work-life balance for me. But I got a call from the Bush administration. They had been vetting actually Diana Taylor, who's she was the New York State banking supervisor. The
girlfriend of
yes,
the mayor.
And the companion of Mayor Bloomberg. And so she had been vetted for this, and I never got the details. I heard that the NRA may have been involved in this. I don't know why, but which I think is terrible, to try to penalize somebody because their companion is good on gun control. But anyway, that's another problem with some of the Senate confirmation processes we have now. So that did not go through. They called me and asked me if I would be interested. I had worked with the FDIC when I was at Treasury, since given my financial institutions portfolio. And I had served on the FDIC's Banking Policy Advisory Committee, so I knew the agency pretty well. And with my Dole connections and past work at the Senate, I'd always had a very easy time getting confirmed, and they were eager to get someone in place because they had an acting chairman, Don Powell, the predecessor, had already stepped down to take another job, another government job. So I talked with my family about it, and we decided it was a great opportunity, and it was disruptive to them because we made a very nice life in Amherst. It's a very quaint college town, great public schools. Scott, we all had a nice life there, but we decided this was a unique opportunity. So with the support of my family, we moved back, and I took the job.
What's your husband do?
He works for the American National Standards Institute. He's their vice president in charge of government policy. He's pretty much been in public policy roles his entire life, too. He's a Democrat. It's a bipartisan marriage. He used to work for Al Swift on the House Energy and Commerce Committee. And so he's been in Washington most of his career as well. And it was easy for him to find opportunities here again. But it was still, it was a struggle for all of us for a while.
Physically, where was your office as chairman of the FDIC?
Oh, we were over very close we were on very close to the White House. Actually, I could see the helipad from my corner office. I could also see the Washington Monument. It was a lovely office. I think that building had been there since the 1950s or so, and very special. It kind of reminded you. I asked them to move my desk when I got there so I could see when I looked up from my computer. I work on my computer a lot. I could see the Washington Monument because it always was a nice reminder of the importance of our job.
How long were you chairman?
I was a little over 5 years. Yeah.
And when you're there, who do you work for?
I work for I work for the public. It's an independent agency, and I think that's something that people. It's important for people to understand about the FDIC and the Federal Reserve Board. Most of these financial regulators are independent agencies. That meant that I was the head of the agency. My fiduciary obligations were to the agency, and the depositors we protected. That was our statutory mandate. Our charter was to protect insured depositors. And I tried to stay very focused on that throughout.
Did the president have at that point anything to say about you? Could he remove you?
No, it's not. No. Sure, you can always be fired for cause, and I would never ever stay in a job if the president didn't want me there. I mean, regardless of the circumstances, I think even though you don't work for the president as an independent agency, he appoints you and the Senate confirms you. But once you're there, you are the head of an independent agency. I think having the support of the president is really important for any senior government job. So my personal view is I would never be one of those people that would kind of try to defy the president and keep a job where I wasn't wanted.
When Barack Obama came in as president, did you just stay there?
Well, so I did. So I actually go through this in my book. I called Rahm Emanuel, who was in the transition, but he was going to be the chief of staff, and I said, look, I'm happy to stay. There's a lot of work left to be done, but I'm happy to go too. You just need to let me know. what the president wants, because I didn't want to, if he had somebody else in mind or was uncomfortable with me for any reason, I didn't want to stay. I just, in fairness to him, he was the new president, and he deserved to have people in these important jobs who he was comfortable with. And Ron was very reassuring about that, and said he was sure it was fine. He was going to talk to Larry and Tim Geithner, who were part of the transition. Larry Summers, right? And so I was very reassured by that conversation. And then several days later, there was a big Bloomberg story, I think it was in Bloomberg, saying that Tim Geithner was trying to force me out. and all this stuff about how I wasn't a team player, and I was too focused on the FDIC and not enough about system stability. And even if I stayed, I wasn't going to be part of any of the important policy decisions. I mean, it was really a petty story.
Where'd it come from?
I don't know. But it was clearly, there was a backlash to it. And Chris Dodd, who was chairman of the Senate Banking Committee, and Barney Frank, who chaired the Financial Services Committee, jointly wrote a letter to the president asking him to keep me. And then shortly after that, he was on CNBC, actually, doing a town hall, I think it was, and said, he liked me and what I was saying, and I had the sense of urgency on homeowner relief that he liked. So that was it, and I stayed. And I tried to reach out to Tim and meet with him to find out. We clearly had disagreements, but I didn't view that as a bad thing or something inappropriate for me to voice differences of views, and was surprised really that apparently the intensity of his feeling had surfaced to the extent that either he or somebody who knew him was leaking stories like this. And we didn't have a very productive conversation, unfortunately, and it was a tense relationship after that, but we still got through it. We did what we needed to do. I always tried to participate, notwithstanding my disagreements. I always came to the table. I tried to change the result many times. We tempered the bailouts or got more focus on homeowner relief than I think otherwise would have occurred if it hadn't been for our advocacy. But clearly, a lot of the policy choices that were made were not ones that I would have made if I'd been running things.
Let me read, this is near the end of your book, where in the epilogue, it's a little bit of a long paragraph, but we'll put it on the screen so people can follow it, and then I want you to talk some more about it. What does all this say about our financial system and our regulators? And there's a lot in the book up to that point. It says that a culture of greed and short-sightedness continues to permeate our financial system. A culture that has infected even the best managed institution and goes undetected by their executives and boards as well as their regulators. It is a culture that reflects a craven desire for personal profit that overrides any understanding or care about harm to others. Indeed, it is a culture that celebrates exploitation of an unwitting public for the sake of a fast buck. Yeah. Could it be any more
well, I
indicted?
think the specific reference was to the trading operations of some of these very large institutions. And I do think there is a very big cultural problem in the trading operations of these large financial institutions. And I do think they're all about, again, you shouldn't categorize everybody, but there is too much of focus on profit and profit at any cost, and viewing counterparties or customers as people to take advantage of as opposed to people to serve. I think that's probably what the Volcker Rule is really at the end of the day all about, trying to rethink the culture of these trading operations into a customer service orientation.
Okay, hold on. Volcker Rule means what?
The Volcker Rule basically is designed to have an overarching prohibition on institutions that are in the safety net, bank holding companies, those that have access, that have insured banks or have access to and/or have access to the discount window, the Fed, that their business model should be about customer service and that their business model should not be making speculative trades for their own profit.
Okay, holding company means what?
A holding company, most of these big banks are really banking organizations, and it's important for people to understand that because that created a lot of the problems during the crisis in terms of the inability to run them through a bankruptcy.
Can you name one?
Sure. Citigroup, JP Morgan Chase, Bank of America, all the big ones are holding companies with hundreds, sometimes thousands of legal entities inside of them. And some of those, there usually will be one large insured bank inside that larger holding company, but there will be other affiliates that do different types of activities.
Did you have any responsibility for any of those insured banks?
We insured them, obviously, and then no, we were not the primary regulator of any of them. We had something called backup authority, so that allowed us, if we thought there was a problem, that allowed us to go into the institution ourselves and take a look. But frankly, that authority had not been used as much as it should have been at the FDIC when I got there. I tried to enhance that, but no, we did not have primary regulatory responsibility for these banks.
Let me read a little more in your paragraph here. It is a culture that could not care less about preserving a bank's name and reputation or maintaining long-term customer relations. But should we be surprised? In 2008 and 2009, we bailed out the risk takers, coddled their managers and boards. Heck, we even made sure that the high flyers who brought AIG to its knees got their year-end bonuses.
Yeah, we sure did.
And what do you think led to the mentality that they thought the AIG for a moment until a couple of days ago decided they're going to
sue the government? Yeah.
And how much was involved in what this taxpayer group in this country did for AIG?
Well, it's God, I hardly know where to start. I mean, I think that was specifically in reference to the LIBOR manipulation scandal.
What's LIBOR?
LIBOR is a key interest rate that is used to determine the interest rate on a lot of consumer products like mortgages and credit cards, and also to determine the prices of over-the-counter derivatives market, what we call interest rate swaps. These are kinds of derivatives that price based on what the LIBOR interest rate is. So there was manipulation of this interest rate. The interest rate was set through a survey of big banks through a British trade association, and it came to light recently that people on the trading desk of these large financial institutions, many of them, were trying to manipulate the process to affect LIBOR to benefit their trading books. So they were hurting their counterparties to benefit their own trading operations. And yes, I don't know how anybody, I think it's just, and this apparently a number of banks were doing this, and we're seeing these enforcement actions being rolled out now. And the London Whale was the same problem.
And that was
the
what?
London Whale was a trader at JP Chase taking huge derivatives bets basically against hedge funds. And he had built up in a particular type of very volatile, complex swap transaction. He'd built up a dominant position, and the hedge funds figured out that he had become dominant in that position. So it was a classic squeeze. They started trading against him, and it racked up tremendous losses, nearly $6 billion at JP Chase. It was undetected by management. And, they said it was a hedge, but I don't believe that for a minute. He was just trying to make money trading against hedge funds in this small group of derivatives contracts. And it hurt the bank. It hurt the reputation of the bank and caused a lot of losses, too.
If you look back on the crisis of, what year would you say, 2008, 2009?
Well, it came to a head in late 2008, yes. Okay.
Who got hurt? Who really got hurt in the system? And like an AIG, did anybody lose?
No. I mean, the shareholders took losses. They took dilution. They weren't wiped out as they would have been in a bankruptcy process. They did take some dilution of their share value. But bondholders, I mean, laymen, obviously, they were allowed to go into bankruptcy, but that was a disorderly failure and caused a lot of problems. Banks, smaller banks, including Washington Mutual, which was the largest of the banks we closed in our traditional process, their managers and boards all lost their jobs. Their shareholders are wiped out. Their bondholders took losses. And that's the way it's supposed to work, whether it's a bankruptcy process or the FDIC process, which really is a government-run bankruptcy. That's what's supposed to happen. When you get into trouble because you make dumb mistakes, you and your stakeholders, the people who funded you, are the ones that are supposed to take the losses, not the government. And so, no, I mean, that's one of the problems with the bailouts is it dampened market discipline by telling those who invest in large institutions, you got to put on the government, right? So if they can take risk and get a lot of profits from the risk taking, and when the risks blow up, we're going to put it back on taxpayers, and that undermines, that in itself makes the system unstable. But no, people at the banks were not really held to the account the way they should have been, other than those exceptions that I mentioned. And I think that's the source of system instability. And ironically, a lot of the Dodd-Frank financial reform law is designed not to fix the problems that led to the crisis. A good part of it's about that, but a lot of it's trying to fix the bailouts to make sure that we get rid of this moral hazard that was created by these very generous taxpayer bailouts of these institutions.
Let me go back to the FDIC for a minute. How many people worked there?
Oh, well, when we started, it was about 4,500, and we ratcheted up to about 8,000 while I was there.
Why so many additional?
Well, first of all, the FDIC had been cut to the bone, really. There had been some brutal downsizing when I got
By
to the FDIC.
who?
My predecessors. In fairness, the agency had gotten very big as a result of the S&L crisis and the banking crisis in the 80s that followed it. And so there was some need for downsizing, but they just cut too far. And that was symptomatic of this kind of self-regulatory mantra that had taken over Washington, that we're in the golden age of banking, we aren't going to have cycles anymore, banks are going to be profitable forever, the housing market's going to go gangbusters forever, we're not going to have any more bank failures, we don't need regulators, we don't really need the FDIC. And so there was this, some fairly substantial downsizing.
Who pays the bill for the FDIC?
The banks pay the bill, and I was very determined not to. We have the ability to borrow from taxpayers. We have a Treasury line of credit, and the FDIC protection is backed by the full faith and credit of the United States government. So there is always that option to borrow from taxpayers. But
so your administrative costs are all paid for by the banks?
Everything's paid for the banks. Yes, they pay premiums that go into a deposit insurance fund, and the premium and the returns we get on the deposit insurance fund pay the operating costs of the FDIC and the cost of bank resolutions.
You cover up to $250,000 per bank,
right,
per individual.
Right.
And as you sit there as the FDIC, what do you not regulate? What do you not insure?
Right. So we don't regulate we don't insure securities firms. You have to be a chartered bank, a regulated chartered bank.
A holding company?
No, we do not insure holding companies. We ended up during the crisis. We were asked to and did for a temporary time guarantee the debt of holding companies, which I really didn't like. We did it. We again dialed back what we were asked to do. But we did for a limited period of time, and that program has finally just expired. All that debt has run off at the end of the last year, so that's a good thing. And there was no loss. There was about a $10 billion gain on it. There was no loss, thank goodness, on it. So, but no, we don't. We only insure insured banks, and then you have to stay below the insured deposit limits. That's right. And it's $250,000, but that's per depositor per bank. So, for instance, if you structure your accounts right, so you can have $250,000. You and your wife can have a joint account for another $250,000. She can have her own account for $250,000. So there are a lot of ways to get more than that in a single bank. But we have on our website, I still say "are" there, on the FDIC's website, there's information about how to structure your accounts, and you need to be careful to make sure you do it right.
Early in the book, you talk about when Hank Paulsen, the Secretary
right.
of the Treasury, who had come from Goldman Sachs.
Right.
You tried to get an appointment with him when you became chairman, and you tried to get an appointment with him, and they wouldn't give you the time of day.
No, I got put off, and then I finally got an appointment. And then when I went over there, I went into Hank's the outer lobby, and they redirected me to Bob Steele's office, who was the Undersecretary for Domestic Finance. So Bob and I had a very nice meeting, and we had a good working relationship. We didn't agree on everything, but we had a very good working relationship. And Hank came by for about 5 seconds and said hi, and that was my meeting with the Treasury Secretary.
Why would he be so busy that he couldn't meet with somebody that's involved in all of them?
I think this, and people say, why were you left out of meetings, or why were people always trying to roll you in things? And I think there are probably a lot of complex reasons for that. But one was there was kind of this view of the FDIC, we're there for the little people. Back then it was a $100,000 deposit. So, if you're a Wall Street titan, somebody who's got $100,000 in a bank is not anybody you spend much time thinking about. I mean, that's just the reality. They deal with much bigger numbers than that. So I think, we're kind of the little people for our deposit insurance, and then most of the banks where we had primary regulatory authority were the community banks, the smaller banks. So there was some sense that we weren't players with the large institutions. We didn't understand them, and even though we insured them, I think, that the Fed and the OCC, which regulated the big banks, that they were really the important people to deal with, and not so much the FDIC.
Tim Geithner is obviously, after you've read your book, is not one of your favorite people?
Well, I would say on a personal level, I think he always did what he thought was right, but we had profound philosophical disagreements, absolutely.
Can you remember the moment where you disagreed the most? And what kind of words you had?
It escalated, yeah. It escalated during the crisis. I think our first disagreement was on what's called the Basel II capital standards, which is an international agreement that deals with how much leverage a bank can have.
What's leverage mean?
Leverage means you borrow. So how much shareholder equity. So banks are owned, like any publicly traded corporation, by their shareholders, right? So you fund your operations with some amount of money you've raised by issuing shareholder equity. And then you fund your operations also by borrowing money. So the capital ratios really deal with the relationship between how much money you borrow to fund your operations and how much money you get from shareholders to fund your operations.
For talking purposes, a bank has $1 billion
Right.
of, not my money,
Right.
but a whole bunch of people like me
Right,
in the bank.
right.
How much cash money do they have to have available
Right.
if we all walked in and said we want our money back now?
Well, that's a different issue, actually. Those are what's called reserve requirements. And I will say that, you know, banking regulation is hideously complicated, and I think that's a frustration for me because it inhibits the ability of the public to weigh in. Reserve requirements really relate to how much cash you have to have on hand to make good on your deposit withdrawals, and those reserve requirements are set by the Federal Reserve. Capital is something else. That's how much shareholder equity you have to use to fund your operation. Now, once you raise that shareholder equity, you can put that into cash to make sure you have enough cash for deposit withdrawals. You can put it into loans. You can put it into a lot of different places, a lot of different types of assets, but they're really two different concepts.
But how much cash do they have to have
How much
available?
cash? I believe the reserve requirement is 10% now. They're governed by the Fed. The Federal Reserve sets the policies, and I believe that it used to be 15, and for some reason I'm thinking it went down to 10%. Now I'm going to have to go back to the Fed's website after this interview and double check, but banks typically have, at least right now, because of the Fed's accommodative monetary policies, they pump so much liquidity into the system. Banks have far in excess of that on deposit with the central bank. But that really relates to how much cash they have. It doesn't have anything to do with capital.
Yeah, the 8,000 people that worked for the Federal Deposit Insurance Corporation, how many people were on your board of directors?
We had a 5-member board, and that was a bipartisan. We had our 2 internal directors, Vice Chairman Grunberg, who was a Democrat, and Tom Curry, who was an independent, and then my 2 Republican directors, John Rich, who headed the Office of Thrift Supervision, and John Dugan, who headed the Office of the Comptroller of the Currency.
What is the Office of Thrift Supervision?
They regulate, so there are different types of bank charters. Again, the banking system is too complicated. This has been simplified somewhat. It used to be there were 2 types of national charters. You could have a national bank charter from the OCC, or you could have a thrift charter.
Office of the Comptroller.
Office of the Comptroller of the Currency. Okay. So then you're a national bank and you're regulated by the OCC. You could have a thrift charter, which used to mean that you're primarily a mortgage lender, and then you're regulated by the OTS, the Office of Thrift Supervision. Or you can have a state charter. Any of the states can also charter banks. And if you're a chartered bank and you're a member of the Federal Reserve System, you're regulated by the Fed. If you're a state chartered bank and not a member of the Federal Reserve System, you're regulated by the FDIC, and that's the vast majority of the banks.
So how many people work for the Office of the Comptroller of the Currency?
Oh, golly, they're significantly smaller. I'm probably thinking 1,800, 2,000, something like that. I mean, the FDIC has thousands of, well over 5,000 small banks when I was there, too, where they're the primary regulator. And then we also have our insurance functions. So it's a much bigger operation, where the OCC just regulates national banks.
What's the biggest bank that you insured?
Oh, well, B of A, I think, had the largest deposit franchise.
Bank of America.
Probably still does. Bank of America, yeah. I mean, J.P. Morgan Chase is larger by assets, and I believe Wells is the biggest by market cap. But in terms of the insured deposit base, I believe B of A was the biggest.
We have a photograph that you have in your book of a lot of the people that you were involved with.
Right.
You're the only woman in the photograph. You can see it over there. Who's in that group? I see Hank Paulsen and Ben Bernanke,
Yeah, we are.
Tim Geithner.
Yeah.
Chris Cox is in that group. Is John Rich in that group?
Yes, John Rich is there. He's next to John Dugan.
And John Dugan?
Excuse me, he's next to Chris Cox. Yes,
Okay.
so it's Tim Geithner, John Dugan, Chris Cox, and then John Rich. Yes.
You talk about being the only woman in that
Right.
group.
Yeah.
Tell us what was your reaction to that, or how did they treat you?
Well, you know, it was always well, it was difficult. It was. I always felt like when I get into a meeting, another meeting had already occurred where the decision was made, and so I was being brought into the meeting, but kind of told what the guys had decided to do, and that was hard. And then I thought there were a lot of bilateral relationships that, you know, one-on-one conversations that I was not privy to, which again kind of fed into decisions being made someplace other than the meeting where I got to go. So it was challenging. It was challenging to have a seat at the table. It was challenging to make our voice heard. I mean, it was challenging to get our views taken seriously.
Let me read it. I just pull this stuff out of your book. Go get a job and find the cure for cancer. Mm-hmm. We will tax you at 35%.
Right.
But go manage a hedge fund.
Right.
And you will have to pay us only 15%. First, what's a hedge fund?
A hedge fund is generally a fund that makes money by arbitrage.
What's that mean?
It means that they try to exploit inefficiencies in the system. They basically try to make money for themselves through trading operations. So, for instance, they will, they might arbitrage different inefficiencies in interest rates or what they view as inefficiencies in currencies. If they anticipate that there's a divergence among the value of currencies, they'll take opposite positions and then make money as those values converge on what they think. I'm not doing a very good job of explaining this, what the true value is. It's very difficult to explain what hedge funds do, and some people think they don't really provide much economic value. But they're trading operations. There's zero-sum gains.
They're taxed at 15%.
Well, they are if they structure their returns as long-term capital gains, and there are various ways they can do that. Yes, they pay themselves with what's called carried interest. So the fiction is they're being paid to manage the money that investors have given them to trade and generate profits. They structure the returns as capital gains, and then they take a percentage of those returns as their compensation. So you and I have wage income, right? So we pay the top marginal rates. But if you have your income structured as a long-term capital gain, then you're going to pay a capital gains rate, which was 15%. It's 20% now with the fiscal cliff legislation.
Let me just dip into a current situation.
Right.
The new Secretary of the Treasury designate is Jack Lew.
Right.
Was the former chief of staff, or is still chief of staff to the president. Let me just read something I picked up in Wikipedia about him. In June of 2006, Lew was named Chief Operating Officer of Citigroup's Alternative Investments Unit and Proprietary Trading Group.
Yeah.
And then they say this: the group he oversaw invested in a hedge fund, quote, that bet on the housing market to collapse, unquote.
Right.
Now, he's going to be the Secretary of the Treasury. I'm not trying to indict him,
right.
but how can we expect a government with Hank Paulsen coming out of Goldman Sachs, with your friend Tim Geithner coming out of the New York Fed, how can we expect to get the average person the fair shake?
Well, that's a good question. I think, and that's another example of what hedge funds do, and a lot of them did take what was called short positions on these derivatives contracts there were trillions of dollars of derivatives that were structured. They're basically speculative bets on how mortgages would perform. So hedge funds took what's called short positions, which mean that they would make a profit the more the housing market got bad. And actually and I talk about this in my book, there were some, not Mr. Lew, but others, hedge funds that were short the housing market who opposed our efforts to get loans modified because that would have helped the housing market, and they actually wanted the housing market to go bad because they would make money if that happened. So it is a whole different world, and one, I'm happy to say the Volcker rule will now prohibit banks going forward from engaging in that kind of activity.
Is the Volcker rule in place yet?
Not yet.
Why is it taken over 2 years?
I don't know. The pace of regulatory reform has not been good. Only about a third of the Dodd-Frank rules have been finished. A lot of them haven't even been proposed yet.
Why do you think they haven't, though? I mean, this was supposed to be the end-all, be-all of all legislation. It left, Dodd-Frank was really directions and authorities to regulators to get the rules done, and the regulators really bear responsibility for some of the problems. Now, in fairness to them, the lobbying against the regulatory process has been quite severe and quite intense, but they need to stand up to that and just get these rules done. It's not getting better with time. Why can't they stand up to a lobbyist? The lobbyist is outside looking in.
So I think there are a number of reasons. One is I think there is what some people call cognitive capture, so a tendency of regulators to start looking at the world through the lens of the industry they regulate. So they're too worried about what those. I mean, they should listen to them. Sure, you should always listen to the industry and everybody else about what the impact of your rules is going to be. But when it gets to the point where you're starting to approach the issue the same way a bank would approach the issue, then you've got a problem. But I think that makes them more responsive to some of this lobbying than they should be. I think a lot of it is it's political pressure too. Unfortunately, on the Hill, there's probably more pressure on regulators to not be robust regulators as opposed to supporting them and wanting them to get these rules done. At the SEC and CFTC, that's been a particular problem because they have to go to Congress to get their funds appropriated so they can operate. And lobbyists will use the appropriations process to try to mess up their appropriations or get their appropriations cut back so they can't do these rules. So the political process has put pressure on them. The industry has. But at the end of the day, they have been too slow too. And you know, most of them are there. They've got fixed terms. They need to just stand up and say, you've had your say, fine, this is what we're going to do. And we're not going to give you 100 different exceptions on the Volcker rule or the derivatives definition or the swap definition or whatever some of these other rules that have been very complicated. We're just going to have a simple, effective rule that's going to make you change your behavior, and you're going to have to start taking less risk and with less leverage. And that's at the end of the day what we want them to do, but the rules haven't been there.
I want to show some video of people that you worked with.
Okay.
This first clip I'm going to show goes back to 2010 in April. It's Carl Levin, the senator from Michigan, and John Rich, the former OTS. That's the Office of Thrift Supervision Director. Let's run it.
Okay.
Chairman Bair writes OTS that she informed WAMU of a ratings disagreement. You expressed, "I cannot believe the continuing audacity of this woman." What's audacious about FDIC telling WAMU about a potential downgrade? You're just telling WAMU. Why is that so audacious that you can't believe the audacity of this woman?
Again, it relates to the fact that OTS was the primary federal regulator.
I understand.
And I thought that OTS ought to be the agency that relayed the downgrade in rating to the new CEO who just took over.
Turf.
Characterize it as how you may. I have the highest regard for Sheila Bair, but these were tense times, and people's blood pressure increases under situations like this, and sometimes we say things that we wish would not appear in print.
Why do people always say I have the highest respect, or and you know, we all sit out there and go, yeah, sure you do. And what is WAMU?
Yeah. Well, I think you try to make things not be personal. They should be. We should keep the level of discussion on policy. WAMU's Washington Mutual, which is a big Seattle-based thrift institution, which John Rich and his agency regulated.
What was he really talking about there?
Well, WAMU failed. It was a $300 billion thrift, not an insignificant-sized institution, and they made a lot of dumb mistakes. They got deep into subprime, deep into alternative mortgages with little income documentation, steep payment resets, and the losses just finally caught up with them. And they had many opportunities to correct themselves, to sell themselves. They raised more capital than they did, and they just didn't do it. They wanted to. They thought they could ride out the storm. They're unrealistic about what their bank was worth, and they didn't take self-corrective measures. Actually, they just kept digging themselves in deeper until we finally stepped in.
John Rich was on your board?
He was. Yes, he was.
Okay, here's another board member, John Dugan. Mm-hmm. All right, this goes back to 2008, and Senator Richard Shelby of Alabama is questioning.
Comptroller Dugan, are you confident that banks have not outsourced their due diligence and risk analysis to credit rating agencies? And is that a problem? It seems to be a concern to a lot of people.
Well, Senator, it didn't take long for you to get right to the heart of the matter, as always. I do think there is an issue with credit rating agencies. I've spoken on this recently. I wouldn't go so far as to say that banks have outsourced it lock, stock, and barrel, but I think that in the recent round that we've seen, that the very high credit ratings for a certain class of securities, these collateralized debt obligations based on subprime asset-backed securities, which were not only rated AAA, but were considered senior to AAA securities. I think there was an undue reliance generally on that rating, but even with the banks, with some of the most sophisticated banks, as they packaged these, there was an undue reliance on the credit ratings, and that shouldn't happen.
What's that all about?
Well, credit ratings were a big problem during the crisis. Rating agencies did not do their job. And I think part of it was the compensation structure. They were paid by the issuers of these securities, the entities that wanted to sell these securities, for the rating. And obviously the issuers wanted high ratings because that made it easier to sell these products. So
let me interrupt just a second. Ratings agency,
ratings
Moody's.
Agencies, yeah, Moody's, S&P, Fitch. They are corporations whose business it is to evaluate the credit quality of securities. It used to be they just did their main business was corporate bonds, and they've actually not done a bad job with corporate bonds. There've been some problems there. But they got into the business prior to the crisis of rating securitizations, which are more complex instruments backed by mortgages, and then derivatives instruments that were derivative of these first-line securitizations called CDOs, which John Dugan was referring to. And they didn't do their homework. They never really looked at the loans underlying these securitizations to see if the loans were properly underwritten.
Who didn't do their homework?
The credit rating agencies did not. Well, everybody didn't. The issuers didn't either. The bondholders, the people who bought these securities, didn't either. They were pretty much everybody.
Is a security a piece of stock?
A security is no. A security in this case, it's a bond. It's stock is equity. It's an equity ownership in an institution. A bond is a credit instrument, so there's a legal obligation to pay back that bond at some agreed on fixed rate of return. And so they rated. So the mortgage-backed securities market. You would have a first-level securitization where several thousand mortgages would be put into a securitization, and that would be divided up into securities, interest in the revenue streams on that securitization pool. But then, and those pieces would be sold off, and then they would divide the securitization up into risk factors. So if you were in the lowest tranche, if there started being losses on those mortgages, then you would as the holder of the lowest tranche of the securities, you would take those losses first before the highest rated.
What's a tranche?
A tranche is just a part of the securitization. So just to take a simplified example of a securitization with 3 different tranches. So the top tranche would have priority claim to the revenue streams coming off of those mortgages. And then the intermediate tranche would have second claim to those income streams. And then the third tranche would have the most subordinate claim to those. So if all the mortgages performed, everybody would get paid.
Let me just ask you this, and this is coming from a real generalist.
Sure. Okay, sure.
When you listen to all of this, and I read your book, and you hear about all the people involved, is it no wonder that the banks and the Wall Street crowd can dance circles around this town?
Yes, it is. And actually, the example I was trying to give, and I go through this in my book in more detail, and you need several pages of explanation, unfortunately, but those are what I was just describing with some of the simpler securitizations. They would re-securitize these. So they'd take the bottom tranche and put all those into a pool and put those into tranches. And they'd take it again and they put those into tranches. Those are what's called those CDOs squared that you probably heard about. It was mind-bogglingly complex. Investors didn't really understand what they were buying. I'm not sure the people that were packaging them really understood them. And the rating agencies kept handing out AAA credit ratings on them to make the investors think that they were safe when they weren't. So the complexity absolutely impaired the ability of the market to make appropriate judgments about how risky these securities were. And so it's what we call the underpricing of risk. Investors were buying this stuff at prices that understated what the true risk was. And then when the losses mounted, everybody was surprised they didn't have enough capital to absorb it.
When were you the maddest?
Oh, boy.
With either the system or the people, and were you
I was mad. I wrote the book and I got mad all over again. I thought maybe I would have mellowed out a little bit, and I didn't. I think probably the Citigroup bailouts made me the angriest because it just was nonstop. And there was the attempt to kind of do a backdoor bailout by letting Citi buy Wachovia, which was a failing national bank, with FDIC support, and we ended up not doing that. And that was a good thing. Then there were 3 different bailouts of Citi, as I detail in my book. There really was never any that much accountability. We did replace the board finally. We replaced some of the managers, but not nearly as much as we should have. And then at the end of 2009, when all those guys wanted to start paying themselves big bonuses again, And
were they ever punished or ever, I don't know, did anything ever happen because they got all those bonuses? Really happen?
No, they got them. It was over the top, and the country was still suffering so badly at the end of 2009, and my own agency had taken all this risk in guaranteeing a lot of their debt, and we had guaranteed that debt for 3 years, and here they are, they're wanting to repay all their TARP and take on more leverage, and mainly so they can pay big bonuses again, because with the TARP capital, there
let
were
me
some
throw some
restrictions on
politics into
bonuses.
this.
Sure,
President
please.
Obama, all through the campaign, positioned himself as being anti-Wall Street and anti-big banks.
Right.
In
Yeah,
reality,
well,
is he?
it was, look, I think I met with him several times. When he first came in, he was very accessible, and then that kind of after several months, that faded away, and I think Larry and Tim probably didn't want everybody else having access to him.
Larry
I don't
Summers,
know.
Tim
Larry
Geithner.
Summers and Tim Geithner, yes. So I think his heart was in the right place, but at the end of the day, he picked people who had been very much part of this. I mean,
make the connection, because you do in the book about Robert Rubin and
Right,
Tim Geithner
right,
and
right.
Hank Paulsen and all the people that come and go out of government to the Wall Street. Is there, again, what's going on here?
well, it's perspective. It's narrow focus on Wall Street and viewing the needs of the country through the needs of Wall Street, and the idea that if you fix Wall Street, you fix the rest of the country, and it's just not so. Their interests are different from ours, and them making big profits and big bonuses isn't necessarily in the benefit of the country. And it's to the hindrance of the country if they think they can take big risks and put it on taxpayers. That makes for
Why
a
didn't they
less
put a
stable
restriction
system.
on these outfits that were bailed out?
Well, there were all sorts of reasons. They did finally, for B of A and Citi, because they had to have multiple bailouts, they did put more severe restrictions on them. But then that's when we found ourselves at the end of 2009, Treasury putting pressure on everybody to let B of A and Citi repay their TARP, their bailout money, so they could pay bonuses again, which I thought was premature. Those were still very sick institutions. But the healthier ones, and this to some extent this is right, the healthier ones really didn't need a lot of bailout money. There was a bit of a liquidity problem, but they had enough capital, the commercial banks. And so, but I think in a desire to camouflage the ones that had real problems, like Citigroup, they pretty much told everybody to take it. But, you go to a healthy bank, like a Wells Fargo or JP Morgan Chase, and the markets were open to them. They had just done big capital raises. They weren't in any kind of, they had capital, they had access to liquidity. You go to them and say, we want you to take this TARP money, and oh, by the way, we're not going to let you have your bonus next year or whatever, then they're going to balk. They're not going to take it. So that was the reasoning.
I'm going to read you just another sentence from your book.
All right.
I have seen many instances when career staff have been too deferential to industry wishes.
Yes, absolutely.
Why? How many of them want to go out of being in government to work for these institutions?
That is part of it. I think this accepted practice of having a career trajectory where you work for a regulatory agency for several years and then go work for an institution that you regulated, I think that impairs thinking. But the political pressure, too, can be quite profound. And I think at the FDIC we had much less of that in terms of examiners thinking they were going to go work for banks. But they had really been beaten down. As I talked about, there had been some significant downsizing prior to the crisis. And then on our backup authority, when our staff in the past had tried to exercise backup authority over some of these large banks, the board actually had slapped them down because of political pressure from the large institutions. So they had also not gotten the support that they needed from the political leadership of the agency. And I think this has happened in the past at the OCC and the Fed too. The principals, the leaders of the agencies have to support their staff and let their staff know that they want them to be independent. They want them to take enforcement actions or whatever else needs to be done if these banks are operating in an unsafe and unsound manner. And the examiners don't always know that they have that support. So that's another problem.
During this period, we're going through the inauguration, and the president's group have called for $1 million contributions from big corporations.
Yeah.
If you were sitting in the FDIC and you're having meetings with the Secretary of the Treasury and the comptroller of the currency, and you knew that a company had given $1 million,
yeah.
what impact would that have on you?
Well, it wouldn't have any impact on me, but I'm, I'm difficult. What can I say?
What impact would it have on most of these situations
it would
you
make
found?
them stop and think. Yeah, sure. Of course, it would make them stop and think. And I think that's one of the reasons why it's good for these agencies to be independent, so they don't work for the president. And I think if you're a lower level person at the FDIC and you have a chairman like me or Marty Gruenberg now, who is a very independent person.
He's the new
He's
chair.
the new chairman. Yeah. You're going to understand that that's not going to matter to us.
I want to show you some videotape. This is Neil Borofsky, who we had on this program, who has a book talking about what it was like working inside the Treasury Department as a special Inspector General for TARP, which is all very gobbledygook language that most of us don't understand. But watch what he has to say.
And as I laid that case out to him and explained to him that he was not being sufficiently transparent, the meeting got very contentious. He, to put it mildly, disagreed with my contention. He used a lot of obscenities in expressing his view that he had been one of the most transparent secretaries of the Treasury in the history of the country, that he had forced the banks to disclose things that no one else would. And it sort of followed this pattern for about 40 minutes of really very explosive, obscenity-laden tirades against me as I was sort of trying to make that argument. And let me be clear, I'm not complaining about that. It's just sort of the nature of a very contentious meeting. But still, inside, I'm still just a line prosecutor from Manhattan, and all of a sudden I've got one of the most powerful officials in the world dropping F-bombs on me. It was sort of this very remarkable moment, and my deputy who had come with me from New York, Kevin Pawlowski, after us just looked at each other, and it was sort of this remarkable thing that here we are trying to advocate for what we think is some pretty common sense changes, and this deep level of animosity and condescension was somewhat remarkable.
He's talking about Tim Geithner, the Secretary of the Treasury, who's leaving, but you write a lot about Tim Geithner in here, and I guess I'm not sure at the end, so many people quarreling about him, was he successful or what's all this contention? Was it good or bad for the process?
Well, I think the lack of tolerance for different views was not helpful. I think, the FDIC had a lot to add to the discussion, especially when we got into 2009, when the system was stable, and we did have the opportunity to restructure some of these banks. And that is what the FDIC does. They deal with troubled financial institutions. They restructure them, they clean them up, they return them to the private sector. And there was not a willingness or an openness to always listen to our contributions, and I think that hurt the process. The discussion about whether things were successful or not, define success. We didn't go over the cliff, so that was a good thing. But we didn't have a robust recovery. We had a struggling recovery. We still do. The financial sector has still been a drag, not a source of strength for the economy. Hopefully that'll change this year. They are finally cleaning up their balance sheets and doing a little better job of lending, but it's been a long time coming. So I think there could have been some things that were done differently, and it would have been nice if there had been more openness to different viewpoints, or at least having open discussion and serious dialogue about it, but we just didn't have that.
Let me back into something you were talking about earlier, Citigroup. How big a company is that?
Right now it's about 1.2 trillion, I think. It was close to 2 when this crisis started. They have been whittling down their assets. At
one point, one of the top people there was Bob Rubin, who was former Secretary of the Treasury under Bill Clinton.
Right. Yes, that's right.
You say basically in your book that Bob Rubin was responsible for bringing Tim Geithner to the Secretary of the Treasury.
Right. That's my assumption. Yes.
And he came out of the New York Fed.
Yes.
And then you say in your book, Tim had always played a staff role, even as the head of the New York Fed. He had basically been the mechanic who had engineered the bailout programs. Hank Paulsen, Ben Bernanke, treated him almost like staff.
Right.
He had been elevated to the role for all of the wrong reasons, boosted by Bob Rubin, with no doubt had every expectation that Tim would continue his Citigroup-friendly policies.
Right.
That seems to be the nub of part of what you're writing about here.
Right.
Did he continue the Citigroup-friendly policies, and did the people at Citigroup make out better because he was at the Secretary of the Treasury?
Oh, I think there's no question about that. That's objective fact. The government was quite generous to Citi. That was a very, very sick institution. They had made just about every mistake in the book.
But they all went away. Bob Rubin's worth millions.
Yeah.
Never was punished in any way whatsoever.
No.
Is
I never
still a
accepted
confidant of the president's.
Yeah, I don't get it. Well, he shows up in op-ed columns and in conferences, and as near as I can tell, never really accepted responsibility for any of this, which I find amazing. You know, and he helped create the beast when they got Glass-Steagall repealed, and he was Secretary of the Treasury and drove that and supported that and got that done, and then to go become the chairman or the executive chairman, is where they made a special title for him, of the institution that was the primary beneficiary of this major policy change. I think the optics were terrible.
Another piece of tape, another piece of something you were involved in. It's Suze Orman and Sheila Bair.
Right.
Let's run it. It's not very long, and then I'll ask you how you got into this.
Okay.
Ever lose one of these? Everyone has, except for people whose money is fully insured by the FDIC. Those depositors have never lost one penny in the 75 years of the FDIC. Good to know in times like these. So here's the question. Do you know if all your money is safe and sound?
Go to myfdicinsurance.gov
and click on Edie the Estimator.
Because the more you know,
the safer your money.
First question, did you pay her to do that?
No, we didn't. She did it all pro bono.
She makes out like a bandit, though, when she's standing next to the head of the FDIC and she's in a big business.
Well, I think the benefit was mutual, actually. She had been a critic of ours, actually, and I started engaging her because she had criticized, and some of her justifications were appropriate, of the complexity of our deposit insurance rules and the difficulty of understanding how deposit insurance rules work. So we simplified it, and she gave us a lot of free time, helping us set up a very user-friendly website called Edie to better explain our deposit insurance systems and our limits. And then as we got into the crisis more and more, where there was a tremendous amount of press speculation about whether we were going to run out of money, people were raising questions about the safety of their insured deposits. And I was fighting that, but I was, I was the head of the agency, so it was going to be my job to do that. And we thought it would be good to have a third person, and Susie's never been one to pull punches, to vouch for us, basically. And she was willing to do that. She donated all of her time, and she donated a lot of time. Her consulting services were completely free on Edie and on doing those ads, and that was a full day of taping.
But those ads run free of charge on television stations.
They're public service announcements.
And so for her, it gives her a tremendous amount of
Well, I don't think does
visibility.
Suze Orman need that. I mean, she's written several best-selling books. She's got a very well-watched show. I mean, I think her name recognition, frankly, was much higher than the FDIC's. I'm not sure. I think we benefited actually from her credibility with Main Street, not the other way around.
Let me ask you one last series of questions. What did you decide to do once you left this chairman's job? Because obviously in this book you write about people the revolving door business.
Right, yeah. So I joined the Pew Charitable Trust. I'm senior advisor there. I wrote the book. I'm joining a couple boards. I go give speeches, and it's a nice combination of things, and I'm enjoying my life right now. And I wanted to practice what I preached, and I didn't think that it would be appropriate to go work for a bank that we regulated. And I won't take speaking fees either for people who use our debt guarantee program or insured banks. So it's what I'm comfortable with. Other people do not follow the same path, and that's fine. But I think it's good to show by example. And we did a lot of things that assisted banks during the crisis, like with our debt guarantee programs and our higher deposit insurance limits. And I didn't want anybody to ever think that there was anything on my mind other than protecting the public in taking those measures. So, again, it was my personal choice. I don't judge people who choose different options, but I do think I wish they would think hard about that because it undermines public confidence in the regulatory process and in government when they see these regulators who had helped industries go and work for them then.
Our guest has been Sheila Bair. The book is called Bull by the Horns. She's the former Federal Deposit Insurance Corporation chairman, and we thank you.
For a DVD copy of this program, call 1-877-662-7726. For free transcripts or to give us your comments about this program, visit us at Q&A.org. Q&A programs are also available as C-SPAN podcasts.